Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. At this week's Investment Policy Committee meeting, we discussed the market's swift and sharp downward response to the FOMC's statement on tapering. In an attempt to instill order to the anticipated unwinding of QE3, the Fed tried to remind investors that tapering does not mean tightening. What's more, Chairman Bernanke reiterated that all future actions will be data dependent. However, the markets had a different interpretation. While taking one's foot off of the gas isn't the same as depressing the brake, the result is similar. Investors don't care if one action is direct while the other is indirect. They just care that the car will slow, regardless. From a technical perspective, as of June 19th, the 10-year Treasury yield is now very close to key chart support at 2.4%, which is the top of an inverse head and shoulders pattern. If yields break above 2.4%, we think we could see a measured move to 3.4% in the next 6 to 12 months. However, we think treasuries are currently oversold and could experience a retracement to the 2% area before the real upside fireworks begins. There is also major trendline support at 2.6% when looking out about 2 months. This level is very significant in our opinion because it has represented a ceiling for the 10-year yield for the past 6 years. So if rates go above 2.4%, they may run to 2.6% or so before we see a decent counter-trend move in yields. So what should investors do? S&P Capital IQ maintains its positive 12-month outlook on equities, but negative opinion on bonds as we see rates rising in response to stimulus tapering from an improving outlook for the economy and corporate earnings. I'm Sam Stovall, and I'll talk with you again next week.